Hello beautiful students, this will be your recap video for FRK 122. This is officially the last video that I'll be making and also my last year of being a tutor for accounting. So it's very bittersweet for me, so I hope you enjoy it and I hope that this helps you. For those of you who do not know who I am, hello, my name is Dominique Pierce and I am one of your tutors for the semester. I have left my email here for you to contact me if you have any last minute questions before the exam. So we will be looking at 4 different things today. We will be looking at chapter 2, which is inventories. We'll be looking at a timeline example. We'll be looking at tips for the financial statements and of course cash flow statements. I would just like to say that I unfortunately will not be able to reteach all this work in a 20-minute video. Unfortunately, I really wish I could for you guys, but I won't be able to. So this video will more be looking at questions that I suggest you go through, tips for how I suggest you study, and examples and important information. So I won't be reteaching all these chapters, but I'll more be looking at tips and questions that I suggest you go through for the exam. So firstly, we will be looking at inventories, which is chapter 2 in your workbook. So first and foremost, inventory is measured in 2 different ways. You firstly have the weighted average method and you have the first in, first out. The weighted average method takes your total value of the units that you have. You put that over the total number of units you have and you times it by the units you have on hand to work out your inventory value at the end of the year. So I have a little picture of pens here because this is a prime example of where you would use this measurement. You'll use it for low cost items that you have a lot of. So loads and loads of pens. If you would have to be doing the valuation of those pens in the picture specifically, let's imagine they're all the same type of pen, they're just different colors. So it would be stupid to go and value each singular pen when you can just take all the pens and divide it by the value, or divide the value by the amount of pens you have to work out the value or the cost of units that you have on hand. Secondly, you have got the first in, first out method, and that just assumes that the inventory that you purchased first needs to be sold first or will be sold first. This you will typically use for perishable items such as bread, milk, eggs, those type of things. How you do this is just keeping the cost the same. So what you bought it for is what you will value it for. And assuming that the ones you sold during the year were the first ones you bought within the year. So the ones that will be left over at the end of the year is towards the ones that you bought towards the end of the year. I hope that makes sense, but think about it as bread. If you go to Checkers or to Woolworths or to Pick and Pay, you always reach towards the back to get the newest or the freshest bread on the shelf, and that is essentially what first in, first out is doing. It's assuming that the bread that you bought earlier in the year, or earlier in the week, I hope you're not using a year-old bread, but the bread that you bought at the beginning of the week will have to be sold before you sell the bread that's left at the end of the week or that you bought at the end of the week. I hope that makes sense. The valuations can obviously be used for different items, so it's not limited to the examples that I've given, but this is the easiest way to remember it. So weighted average is for a bunch of product that has similar values that you can kind of just weight average and get an average amount for. And first in, first out is assuming that the product that you bought first will need to be sold first before you can sell the product that you bought towards the end of the year. Next up, we have net realizable value, which is essentially decreasing the value of assets that you have on hand or inventory that you need to sell because it is either outdated or it is damaged or there's something wrong, not wrong with the product, but you can't sell it for what you anticipated you can sell it for. So you need to decrease the value of it in your books. A prime example of this is old cameras. So say, for example, the photo of the camera on the left, that is an old camera. So say we had that in our shop and we had 1,000 of those. And all of a sudden a new model comes out. So the new camera that's on the right in the slide. We now can't sell the camera on the left for the same price we would have sold it for, because it has now decreased in value, because there's now a new, better camera out. So we need to decrease the value of the camera on the left in order to have it correctly valued in our financial statements. So I've put the formula for working out the net realizable value in the slide. Once you have worked that amount out, the rule for net realizable value is the fact that the inventory will be valued at the lowest cost. So either between the net realizable value and the cost, whichever amount is the least is the amount that we will use to value the inventory in our financial statements. Next up is the insurance section in the inventories chapter, and that will generally be insurance claim due to loss of inventory due to a fire or due to theft. Those are the two most common ones. There are, of course, other examples, but those are generally used. So like in the photo that I've shown there is a big fire in the warehouse, so we need to now claim insurance for the inventory that we have lost due to that fire. I have put the general journal entries in here. These will typically stay the same for all examples. This was the amount shown here, or just the amounts that was shown in an example in the workbook, but obviously those amounts will change. So say, for example, the question tells us that we had a fire in our warehouse and we lost 50,000 rands worth of inventory. That amount will be where I said amount of inventory lost. That is where you'll put the 50,000. Then further in the information, it will tell you that you have a claim for 50 cents to the rand of what you have lost. So you'll work out 50% of 50,000, which is 25,000, and that will be the amount of insurance that will pay out. So that is essentially how it goes. This is what it will look like every single time. And yeah, so this is pretty easy. Here I've put a list of questions that I suggest you revise and go through and learn and know how to do. We have question 2.3, which focuses on the different measurements. So that is the weighted average and the first in, first out method. Then we have question 2.6, which is an insurance question. So making sure that you know how to account for insurance due to a loss. Question 2.8, which is a simpler, in inverted commas, manufacturing question. So you can learn the basics of how to do the manufacturing question. And lastly, question 2.12, which is a more difficult manufacturing question that I do highly suggest you know how to do. I also probably know that you don't look like this girl while you're studying, but I do hope that this video helps you a bit and that you look like this when you're going through the video, because I know I never look like this when I'm studying, especially not full counting. So I hope this is helping so far. Next up, we have the daunting timeline example. I cannot stress more how immensely important timelines are. You will need to do it more than once in your exam. I can guarantee you'll need to do a timeline for working out depreciation. You will need to do a timeline for working out interest on a loan, and it will come up more than once even in your exam. So please, I can't stress enough how important timelines are. So please concentrate and know how to do timelines, because they will help you tremendously. So here is my example. So we have bought a vehicle on the 1st of April in 2016 for 500,000. I personally chose a Tesla just because they are very cool. So we have a Tesla that we have now bought for 500,000 rand. It depreciates at 15% using the diminishing balance method. our financial year is from the 1st of Jan to the 31st of December, and we need to work out accumulated depreciation at the end of 2019. So I have a list of 4 steps that you need to follow when doing a timeline question. So firstly, you need to draw your financial year in one color. So say you draw it in red. Secondly, you need to draw your asset's birthday in a different color, so blue. Thirdly, you need to work out the amount of months between each colored line. Sounds strange, I know. And then fourthly, you need to work out depreciation. So this whole thing sounds very weird, I know, but please follow in the next step and it will make a lot more sense. So we know that our financial year runs from the 1st of Jan to the 31st of December. That is our financial year. We know that we have now bought this really cool Tesla that looks like it's from the future on the 1st of April in 2016. So we have now drawn our financial year in blue. So we have the 1st of Jan 2017, we have the 1st of Jan 2018, and we have the 1st of Jan 2019. That is the blue color, and that is our financial year. So we have done the first step. The second step is to now draw your birthday for the asset. So we were told that we bought the assets or the Tesla on the 1st of April. So we now need to go draw in the 1st of April into our timeline. So in the red color, we have now got the 1st of April 2016, we have the 1st of April 2017, 1st of April 2018, and 1st of April 2019. So step 2 complete. Third step is to now work out the amount of months between each line. So we obviously don't need to work out from the 1st of Jan 2016 to the 1st of April 2016 because we didn't even have the asset then, so we don't need to work that out for depreciation. So from the 1st of April, which is when we have now bought, or 1st of April 2016, when we now bought the Tesla, to the 1st of Jan, which is our financial year birthday, we have 9 months. So when you're in the exam, literally use your fingers and count April as 1 month, April, May, June, July, August, September, October, November, December. We now know that that is 9 months. Please also just be aware of the 1st of Jan and the 31st of December is essentially the same thing. So if you had to, for example, have bought the asset on the 31st of April, you will not include April into your calculation because you didn't have it for April in that example. I hope that makes sense. But we have now got 9 months between the 1st of April 2016 and the 1st of Jan 2017. Next step is to work out the amount of months between the 1st of Jan 2017 and the 1st of April 2017. That is, again, use your hand, January, February, March. We don't include April because it's on the 1st of April, so we didn't have it for April. So that is 3 months in total. On the 1st of April, we have now had the Tesla's first birthday. We can sing happy birthday for it. We can throw it a party if you really want to, but it has been 1 full year that we have now had the Tesla. We know that on an asset's birthday, when we're using diminishing balance, we have to decrease our carrying amount by the accumulated depreciation for the first year's birthday. You will see that in the next question, well, the next slide where I do the calculations. But what we have essentially figured out now by doing this whole thing is that we have a 9 and 3 month configuration. So we have 9 months and 3 months differences between the financial year end and the birthday of our Tesla. You will see in the next slide why that matters and how that changes. But for now, we know that it is a 9 and 3 month configuration. This 9 and 3 month configuration will go throughout the asset's birthday. So it will always be the 9 and 3 months. You'll see that in the next slide as well. So here is our calculation. I have broken it up a lot more than what you really need to, but I purely just wanted to show how each calculation was gotten to. So you can shorten this if you really want to. If it works for you, by all means do that. If it is more complicated though, I suggest that you just do the longer calculation and get it right instead of trying to do shortcuts. But now we can finally go through the answer. So in our timeline, we had the 1st of April 2016 to the 1st of Jan 2017. That was our first 9 months that we have now had our beautiful Tesla. So we take the full 500,000, times that by the 15% depreciation, and then we times that by the 9 over 12 months that we had it for that financial year. So for the 2016 financial year, we had it for 9 months. Now our 2016 year has ended. We are now into 2017 financial year, and we had it for 3 months in 2017's financial year before it was the birthday of our beautiful Tesla. So our second calculation is the 500,000 times 15% times 3 over 12. Then it was our beautiful Tesla's birthday, first birthday, and we now need to change the carrying amount because we know that on the birthday of an asset, the carrying amount needs to decrease by the accumulated depreciation for that specific year. So for the 1st of April to the 1st of Jan 2018, we now have 500,000 minus 75,000. That is our new current carrying amount for the second year of our Tesla's birthday. Please keep in mind that the 56,250 plus the 18,750 is where I got the 75,000. So it is the cost minus the accumulated depreciation, which is what gives us the carrying amount. We get 425 by working that out. I didn't put 425 just so I could show that it was 500 minus the 75, but we now have 425, times 15% times 9 over 12. So if we had to have been asked what the depreciation is for the year of 2017, we would have to take the two arrows with 2017 in them. So 1st of Jan 2017 to the 1st of April 2017, which is the 3 month of the first birthday of the Tesla. And then from the 1st of April to the 1st of Jan 2018, which is the 9 month difference in the birthday of the Tesla. So if they had to ask us for the 2017's amounts depreciation, we would have to take those two amounts and add them together. But because this question is asking us for the accumulated depreciation for the end of 2019, we have to go through the whole thing again twice. So then we take 2018, the 1st of Jan 2018 to the 1st of April 2018, which is the 3 month section of the second birthday of the Tesla. We have now, then after we've calculated that, we now have the second birthday of the Tesla, and we now need to decrease the carrying amount again by the accumulated depreciation, because we know that on the birthday of the asset, we need to take the carrying amount minus the accumulated depreciation for the year before, for whichever year the birthday. So this one's second year, which is the 47,813 plus the 15,937 is the accumulated depreciation for the second birthday, and we need to take the 425,000 minus those amounts to get the new carrying amount for the third year birthday of the Tesla. And that is the calculation that we do again until it's the third birthday. And then we have to take the carrying amount again and minus the accumulated depreciation. We work out the accumulated depreciation or the depreciation for 2019 in order to get the full depreciation at the end of 2019. So once you have followed that calculation, we now have all the amounts up until the end of 2019, and we are able to work out the accumulated depreciation, which is basically just all those amounts that we've worked out added together, and we then get our accumulated depreciation for our Tesla at the end of 2019 as 119,033 Rand. I really hope that this made sense. If it didn't, please don't hesitate to email me. I'll try give another explanation. But That is essentially how you do a timeline question, and that is how a timeline helps, because you are able to break up your calculation into a bunch of little pieces to make it a lot easier for you. The next section is the financial statements section, which I unfortunately can't reteach because it combines all the chapters into one and tests if you are able to put different information into the right sections in your financial statements, and then you need to make adjustments if there are any. So that's essentially what chapter 5 is. It literally takes everything you've learned this semester and puts it into one big question. So I know that sounds extremely daunting, but it really actually isn't, because it's taking little baby tiny pieces of each chapter, the easiest sections of each chapter, and put it into one big question. So basically what's important with the financial statements and the question that you'll get for financial statements is that you'll probably get a pre-adjusted trial balance, and then you'll get a bunch of different adjustments, and you will have to prepare your financial statements based off of that trial balance, which you have done more than once now. It was in your module test 2, it was in some of your ICTs, so you've done it more than once, and I'm pretty sure you're capable of doing it again. So the questions that I suggest you go through is exercise 5.3 on page 144 of your workbook, exercise 5.4 in your workbook, and question 5.10 on page 84 of your question book. I've also put in the slide what goes under each statement. So in your statement of profit or loss and other comprehensive income, all your income and expenses go under that statement. Then you have your statement of financial position, and that accounts for all your assets and liabilities. I've put and equity in brackets because your statement of changes in equity actually works out the equity amount, so you're actually not doing any calculations of equity in the statement of financial position, although it is included in there, so please include it, but you don't do any calculations as such. Then, like I said, in your statement of changes in equity, you have all your equity, so your capital contribution, your drawings, and your profit or loss. And then lastly, you have your statement of cash flows, which is all your cash. So anything that has to do with cash will go into your cash flow statement. And the last section that you guys asked me to give tips on was the cash flow statement, so chapter 10. So I, of course, cannot reteach, as everything else, the whole entire statement of cash flows. But I have put an example here so that you can see, because something that is extremely, extremely important that a lot of people forget about is your brackets. What is an inflow? What is an outflow? All the stuff in brackets is an outflow. Sorry if you heard that, that was my dog. And everything that's not in a bracket is an inflow of cash. Outflow, cash going out of the business. Inflow, cash coming into the business. So please, please, please remember your brackets. They are extremely important in your cash flow statement. And then I also just said here that only cash items. So you will see that you need to take out all your non-disclosed items, and your non-cash items all come out. The most difficult part of the whole cash flow statement is definitely the operating activities. I did make a whole dedicated 2 videos on operating activities, and I split everything up almost perfectly for you to understand. So I suggest you go through those 2 videos. They are pretty good, if I may say so myself. So to get to that, you go to chapter 10, subject content, and it's under lecture 2, Wednesday, the 10th of November. Once you have gone through those 2, I promise you'll be able to do every single operating activity section of cash flows, I promise. And then I suggest that you go through question 10.7 to prep for your exam, because it tests all 3 sections, which I assume will be asked in the exam. I've personally not seen the exam myself, but I have been a tutor for a while now, so I know essentially what they like asking. So I suggest you go through question 10.7 and understand question 10.7. in your question book. And that is the end of this recap video. Thank you so much for listening and for going through it, and I really hope it helped you. If you have any questions, you can find me at my email address, and I will gladly help you. Thank you so much for the amazing semester, guys. You guys have been an awesome group to teach, and I'm going to miss you guys a lot, and I can't wait to see you guys in the workplace one day. Bye bye.